Tonight we're going to start with credits. We're going to go review what we left off on, loan boarding and auditing the file. We're going to have a quick quiz and see how much information you're retaining. And then we're going to spend the last half hour back on analyzing. Again, you are going to analyze 3 more tapes. So by the time the process is finished, as long as you are able to retain at least 60%, we're good. The first thing when you see a tape of loans, some vendors will send you a tape and they will send you a credit for all of those loans on that tape. Some of them will just send out a tape and they will say, tell me the loans you're interested in and I'll send you the credits for those loans, right? You sign your non-disclosure first, so you get the tape, you request the credits for the vendor. The first thing that I want to check for on credit is what? Absolutely. The same thing you check on the tape. What is the status of the first? So on this credit, we have a $96,000 loan, Provident Funding. We have the borrower name. We have the date ordered. You want to see if it's more than 30 days old, you need a fresh one. You never want to get a credit report older than 30 days. Look at the borrower name, the social, and make sure the address is the same as the address on the tape. I'm going to pay attention to that because the seller may have some information that the borrower lives somewhere else, and that's how you can tell if it's on the occupiers. Then it will have employer. Now each credit report is different. It is say borrower, co-borrower, then they have employer. If there's information there on the employer, it will be there, and it will tell you the last date it was reported. Right? See, position, since, verified. And then across the top, it gives you the status of each column. Like you have the creditor account, date reported, date open, last activity, high credit balance, payment term status, and then a history. Then I also have the past due amount. So this borrower, March of 2003, took out a loan for $96,000 on their first mortgage. They left owing a balance of $77,000, and they had a $795 a month payment. This particular borrower filed Chapter 13 bankruptcy, and it included purchase money first. So this bankruptcy included the purchase money mortgage. So you have a home equity line of credit and a purchase money mortgage.
Meaning the first mortgage?
Yes, the first mortgage. So you can have a purchase money second also, or you can have a HELOC second. So a HELOC, you go to the bank, you get a home equity line of credit. Purchase money mortgage is when you go and buy a house, they give you a second at the same time they give you the first. It's a purchase money mortgage. So the UPB is $77,379. So the senior payoff right now, because this loan is a non-performing loan, we won't have that information. So then you have some other smaller accounts, $4,000. All of these loans were included in bankruptcy. Some were charged off and were not included. Then you have the indicators by 30, 60, 90. That's pretty straightforward. So sometimes if you cannot locate a first mortgage on a credit or a second mortgage on a credit, you need to pull all 3 bureaus. Or you need to tell the seller, can you give me a tri-merge report? Because I don't see the second mortgage. I can't verify the second mortgage on a borrower. Sometimes the seller will just give you the borrower and not the co-borrower. Or give you vice versa, the co-borrower and not the main borrower, and you're pulling a credit, or they furnish you a credit of the co-borrower and nothing is there. It's on the borrower's credit, the main borrower. Experian usually have all the data, but if we pull an Experian report and we can't find certain things, then we'll go in and pull the tri-merge. You really don't want to pull a credit unless you own a loan. Right? I got a $2,000 lawsuit now against me for basically a vendor sent me a tape and I couldn't find a mortgage and I pulled the tri-merge. This particular borrower was one of those people who monitor their credits, and then my vendor was supposed to have me set up as a soft pull, but obviously it didn't because the guy claimed that his insurance was higher because his score was dropped because I pulled his credit. That was his reasoning for filing a lawsuit for $2,000. You should just have the seller send you the credit report. This is standard in the industry. The seller won't sell you loans without sending you a report. They won't say, pull your own credit. No, they will furnish it with you. Because they should have it. Because they use it when they purchased it. And if not, they'll just pull a fresh one. So I want to teach you guys the right way not to pull it unless you own the loan. Now, once you have your loan sale agreement, you can go ahead and pull it because you can prove that you own the loan at the time the credit was pulled.